Right, how are we all doing? Just going to continue on like we were in basically every other video I've ever done, to be honest. I have been thinking about getting a webcam up and going just to film myself while I'm doing this. I don't really know how I feel about that, but I have read statistically you're more likely to get more views if you do that, so it might help the channel. For those of you that don't know, I have no idea what I'm doing effectively. Never had any financial training, no financial education. I don't know anybody in finance, and basically the whole point of this channel is that I am trying to record my journey effectively to whether or not I can become a successful investor. Now, none of this is advice. This is all an opinion, my opinion, and obviously my opinion can change at any point. The whole point of this really is that should I be able to become a successful investor, and by successful investor I mean somebody that can, get better than the returns of the S&P 500, because otherwise you might as well just buy an ETF, you know what I mean? If I can do that, then this can be watched by anyone else, and it would be a sort of blueprint for anybody that's interested in finance to go on and maybe become a successful investor themselves. Now, I am a value investor, so a lot of you might find that boring, but it is what it is. That's where I'm coming from. It's really the only sort of investing that I can remotely subscribe to. I did start off with some technical analysis, how I first got into the markets, and it's moved on to, a level of financial analysis that's probably not particularly high, but I'm learning all the time as I'm going. So that is where we are at. I started looking at TriNet earlier on today. Pulled up some of the statements, asked a few questions about what it is. Now, TriNet is it says here, professional employer organisation. So effectively, a company will go to TriNet and say, we want your services. There, where have I got it down here actually. End to end, if you become a customer of TriNet. So this is what will happen. You're typically a small or mid-sized business. You're tired of handling your payroll, benefits, or HR. So instead of building an HR department, you hire TriNet instead. So they basically take on your employees. So you remain the operational boss, but payroll, taxes, benefits, HR, compliance, any legal stuff is all handled by TriNet. They're technically employed by TriNet, but work for you. So all your employees would then have to sign a new employment documentation. But they enroll in benefits. They get a new payroll system. Let's see what else it says here. More options, health plans, 401k. This is one of the biggest reasons companies switch. So each pay cycle they submit hours, salaries, bonuses, and then TriNet will run payroll, withhold taxes, file tax authority, pay employees directly. So you don't have to deal with any of that. The company wouldn't have to. They hire worker compensation, handle worker compensation, insurance, employment practices, claims administration. You're effectively buying insurance through TriNet. They price it and manage it. So the majority of their revenue comes from this insurance. I think they said up here somewhere, it's like 85% of their income, there goes insurance services. Now, if we get the balance sheet up, one thing I noticed straight off the bat is because they've got quite a low enterprise value, especially compared to their market cap. And it's all to do with the amount of cash they have on the books, which is pretty high. I think this is done in millions. In millions, yeah. So they've got almost 2 point. Where are we looking? There you go. Sorry, 1.7 billion in cash on the books, but it's restricted. And the reason why it's restricted is because it's for the insurance side of it. So the insurance side of it, when you're a TriNet customer, you don't buy insurance yourself. TriNet bundles insurance into your monthly bill. You pay them one combined invoice. So that includes health insurance, workers' compensation, other benefits like dental and stuff like that. But most of that money is not kept by TriNet. So the majority of TriNet's insurance revenue is actually pass-through revenue. So TriNet sets a monthly cost per employee. So total insurance is 700. 50 employees for 35,000 a month. So this entire 35,000 shows up in TriNet's insurance services revenue. Now, they then pay insurance carriers, pay claims, cover administrative costs, and that would cost maybe 32,000. So actually, out of the 35,000 a month that's come in, 32,000 is going to go out straight away. So there's only 3,000 that actually stays with a TriNet. I think you can see that here in the income statement. So insurance service revenue, say, because this I think is the payroll stuff, and then insurance service revenue. So they say they got 4 billion or 4.2 billion. Actually, the cost of that is 3.8 billion. So they're only keeping the difference between that. Apparently there's two different insurance models inside as well. This is sort of where I stopped. Go and pick the kids up from school. We're back at it now. So got health insurance, which is mostly pass through. Negotiates large group plans with insurers, pools thousands of employees. Economics revenue because full premium you pay, premium paid to insurer, margin small administrative spread. I can't speak tonight. So the second one is worker compensation. TriNet often acts more like an insurer itself, prices risk across its entire client base, manages claims. So the economics equals the revenue, which is the premiums you pay. Cost equals actual claims paid over time. This is where real underwriting happens, price volatility comes from. So because accounting rules require gross premiums collected, even though 80 to 90% is passed through, TriNet looks like a 5 billion revenue company, but actually it's much closer to 700 million. Yeah, what drives profitability? Claims, so basically normal insurance stuff, classic insurance underwriting. So let's have a look. Where else? Oh, fucking yawning again. Yawning again, pardon me. The insurance side of TriNet is best understood as a large-scale risk pooling benefits aggregation engine where most of the revenue is passed through, but profits come from pricing risk slightly better than actual outcomes. So, 85% of revenue premiums flowing through, small percent of that is retained, which is the real economic value. If you want, I can break down TriNet's insurance margins. Okay, so I've just then asked, because I noticed that they had a huge... if I look at it on the screener, just on the screen, this is what the screen is saying. It's 1.97 billion market cap with just under $1 billion in enterprise value. Now, generally, the only way that can happen is low debt, high cash, which we've seen on this balance sheet. So they have some debt, non-current debt of 895 million, so just under $1 billion. Current liabilities, nothing on the revolver. Doesn't look like they've got anything debt-wise this year. And then, like I said, they've got 287 million in available cash and then 1.7 billion in non-available cash. So I said, like, why is the cash restricted? Which is a bit of a silly question in hindsight. The restricted cash exists because TriNet is holding money that isn't really theirs. It's set aside to pay insurance claims and meet regulatory requirements. So, I don't think I've dragged this into my spreadsheet yet. I haven't, so let's do that. I can't remember what the ticker was, that will help. TNET, T-N-E-T, right. Did I put it in here? Just want to see what a quick return on capital is. So negative tangible book value. Return on capital is quite high, historically high as well. Look. So it's pretty good. What we got? Price is simple free cash flow. 4. And okay, 7 times on the market cap. This is the problem with the enterprise value here, though, is that it makes it look like a good investment, but you actually can't touch most of the cash. We'll drag it in anyway. TNET. Price of the stock is actually appreciated. Not a lot, but you know, a good amount in the last month or so. Sorry, you just got to put up with the copy and paste in a minute while I try and get this into the spreadsheet. I'm sure there is a quicker way of doing it, but that's where we're at. So let's have a look. Just have a look. Yeah, revenue, cost of revenue, so gross profit. I roll in 12 months basis. I've actually only got 591 million. I'm sure that AI said it was 700, but that's actually significantly down on previous years. I still need to change it over to diluted shares as well, I think, really. Stuff that's heavy on stock comp. They heavy on stock comp. Cash flow, stock-based compensation, yes, they are quite heavy on it. So quite a high free cash flow in this then. We'll check it against the trading at half of revenues, is it? $105 in revenues, only $45 price, 39 with EV. Yeah, return on capital's come down a lot. Let's see what that was actually year on year EBIT. Well, that doesn't have it. Look, that's annoying. What it does, you just have to work it out. $270 something, 73. What have I got it as? 137. Okay. This is year end as well, isn't it? That's interesting. What is the net income? 155. Does that at least match up? Am I reading the wrong place for a start? Net income 159 is close. Close enough. $55 million in interest expenses. That's what's on here. 56 million. That's interesting how it's so different, isn't it, at this point? Total revenues minus. Okay. Don't know why that's so different. Problem is I'm not in control of this data, it's just how it is. Costs and expenses, that's everything there from revenue. That's because the revenue's not correct, is it? What have I got for revenues? 4994. And the actual revenue is 5010. So the revenue's not correct. $70 million in revenue missing, which would almost make up for that amount, wouldn't it? Nonetheless, what's the operating cash flow then? This is why sometimes you just got to check the data. 357 operating cash flow. Down here. 303. So we're way out. Well, probably can't read too much into this one then, can we? What would we say? The purchase of marketable securities, acquisitions of software, 70 million. So we'd say there's 200 and what? Proceeds from the sale of a business is one off. So net operating activities minus this, we're going to use this as capex because this is generally just what they're doing with their cash. So 300 minus 70, 270, but then they got stock comp of 65. Oh, maybe this is where it's coming from because I take away stock comp. What was that? 230 minus 65, 165. Now we're probably in the region of why it's off my simple free cash flow. 279. No, so I'm still way out. The data's not right on this one then, is it? Unfortunately. So all that, learning all that about the business just to fuck it up with shit data, but it is what it is at the end of the day. Can't do a lot about that. So if we're saying the enterprise value is what, a billion? What have I got the enterprise value as on here? 1.8 billion. And what is it on here? 1 billion. Have I got the right? 45.78. Something ain't right, is it? Nothing adds up there. Price is correct, but is my share count out? I've got a market cap of 2.15. They've got a market cap of 1.97. What has Yahoo Finance got as a market cap? 2.1. So actually mine is more accurate than this one. Okay, what did I say my enterprise value was? Market cap was 2.15. Okay. Maybe the let's refresh this, see if it changes. 2.11 billion, there we go. Alright. Now we're in the right area. I just hadn't refreshed that for a while. Okay, there's a couple more that's popped up higher up as well. This is where, I mean, my data I don't think is still correct, is it? But we've got a market cap, enterprise value of 1 billion. I've got an enterprise value of 1.7 billion. Is that because they're not counting restricted cash? Rightly so. And they are. There you go, yeah, 1.6 billion in there and the other assets. So the data's right on that one. We'll give them the credit for that. 340 million in cash when it's actually 287. So the data's still wrong. But at least it's not counting restricted cash as actual cash. I mean, it's there, isn't it? But you can't do anything with it. Right. Let's just see what we can get here then. So we've got 100, what did I say? 160 minus 70, 130 minus 65. 255 million in free cash flow. What's the enterprise value? Let's use my enterprise value. 155 million free cash flow. 156,155. 12 times earnings, or 12 times free cash flow. Not interested. Let's just see if we've got any future forecasts, but not interested in this already. Say already, we've wasted 15 minutes on it, but there we go. They announced any forecasts. So revenue flat, slightly down. Ooh, which is on core earnings. Yeah, insurance cost ratio, combined ratio in it. That's the insurance thing. The ratio they all watch. Weak employment growth. Healthcare inflation still high. Interest income headwind expected 25 to 30 million decline. Lower rates, lower retention sales expected. Big picture, what management is signaling, we're stabilizing this in the business, not accelerating it. Okay, so it could get worse and your multiple's going to get higher. Despite the outlook, 400 million buyback authorization. What would that get them? What's the current so-called share count? Up here. $47,300. So, what did they say it was? 400 million. Divided by, this is if they exhaust it though, right? And let me say 40. What is it currently? Post 45, so we'll say 46. They could get rid of 8 million shares. They've never done anything that big before. Right, we're just going to look at that and move on. This has come up in this new Talent Solutions. That's another bloody personal services. Commercial services, okay. I wonder what the sector... What is the sector average EV to free cash flow, just to see what others are trading at. This there isn't okay. Median EV to EBITDA is 24 to 29. Typical lower mid-market deals 4 to 7, so you're above that already. Think, aren't you? I got EV to EBIT down here. I have something down here. Oh no, I haven't. It's 5 to 8. So they're saying 5 to 7, but if you've got declining business, they're telling you that, so you'd be on the lower end of that multiple. I don't know. Just wasting time on it now, so let's just fuck it off and move on. What's this? High water ethanol. Ooh. You can stay at that. Not interested. Well, I say not interested in that. Doesn't trade very often by the look of it. I've got all the way back to 2012, and yet there's... What has happened there? Okay, that's too messy to look at. So it's FVRR. E-commerce platforms allows people to buy and sell digital services. I mean, that was significantly higher. Holy hell. Heard of this business or not? Tangible book value. It's got $7 tangible book. Really? Alright. Very low enterprise value as well. What's this say? FVRR. See what it comes up with. So, simple free cash flow is positive. Return on capital is now positive. First time in years. Supposedly got 725 intangible book. What's the market cap? So it's going at 4 times free cash flows. Okay. Let's just have a look quickly on that TNET. Sale. Last purchase was early last year. $73 for $1 million. Okay. Anybody else? Any funds holding it? 64% of their portfolio. Jesus Christ. Nothing there as well. What? When did they buy this? 40. Even 40% of the business as well. Anyway, Fiverr. FVRR. No insiders buy-in. Very telling. This is in the last 2 years as well. 100% portfolio, 100% portfolio. So probably insiders of some sort. Jonathan Kolb, Misha Kaufman. Do we look at Fiverr or not? Have a look. Where is it based? Tel Aviv, Israel. Financial statement, balance sheet. Cash 125 million, current assets. So 126 million in goodwill, 36 million. So yeah, they probably do have some reasonable tangible book value. 400 million, so user funds, what's that? Oh, I don't really understand the business, so we'll see. But half of that is, you know, effectively cash, effectively low long-term marketable securities. PP&E is quite low. Goodwill's quite high, but intangible assets aren't too bad. See, operating loss. Okay, so it's made losses. Literally made losses on the actual business as well, because there's no write-downs or anything. It has done for a couple of years. It's just not as bad this year. Sales and marketing costs have gone up significantly. Look, 15 million, is it? Yeah. R&D's around about the same. Profit's gone up, but cost of revenue's gone up. So what's fucking this over then? General and admin. Surely that's stuff that they can control. So they're not doing a very good job of it, are they? So the cash flow's got to be... What's in this? Share-based comp, fucking hell. So half of your CFO comes from stock comp. What would their actual capex be? 647. Depends whether or not they need bank deposits to function. Don't know what they do. I did quite like the question that I asked. Is it 2 hours? Yeah. The question I asked last time, actually, where I said, like, what is the what is the end to end? How does this company work end to end? And then it literally told me like what a customer would do, what the business would do. Marketplace, supply side freelancers, how it makes money, the model is simple but powerful. It doesn't actually explain what it does. Revenue segments, marketplace. Right, here we go. We're going to have to ask this end-to-end question then. What does it do in simple terms, end to end? As a customer wanting their services, what happens? End-to-end terms from a customer's perspective. Basically an online marketplace where you can hire someone anywhere in the world to do a specific task quickly, like a logo. Okay. What actually happens? You arrive in need. I need a logo. You search or browse. You see listings called gigs. Okay. So someone will say, oh yeah, I'll design it for you. You compare options. Each freelancer, you check their portfolio reviews. This replaces usual back and forth. You place an order 2 ways: instant purchase or customer request. Custom request. Fiverr holds the money, pay Fiverr, not the freelancer. Fiverr keeps the money safely until its work is delivered. This reduces risk for both sides. So you pay them up front, do you? Yes, by the look of it. Freelancer does the work, they deliver within the agreed time frame. Okay, payment is released, Fiverr pays the payment, Fiverr keeps 25 to 30% cut. And what's behind the scenes, what you don't see: matching your relevant freelancers, payment process and dispute resolution. Example, you need a logo, pick a freelancer, pay Fiverr, get free design options in 2 days, request one revision, approve final logo, Fiverr takes fee. Why people use Fiverr? Okay, simple meta models like Amazon, instead of products, you're buying services. Right, okay. Simple. See, that's quite a good question to ask. That's the one that I literally only asked recently in that last one, but when a company is like, what's going on here? Ask it to tell you end to end. Pretty decent question, I think, if you're trying to understand a business. So just under half in the United States, so it's quite a worldwide company. Marketplace revenue, core commissions, service revenue, advertising, subscriptions, and add-ons. So I take it the marketplace revenue is from the end to end you just mentioned. What is the services revenue? Marketplace revenue, okay. Services revenue actually is Fiverr's way of making money just beyond the transaction. Freelancers can pay to promote their gigs. Okay, logo designer pays Fiverr to show up at the top. Fair enough. Seller subscriptions. Freelancers can pay monthly for advanced analytic tools. Okay. Buyer add-ons, premium features, faster delivery fees. For companies rather than individuals, this is Fiverr trying to move up market into larger clients. AI and workflows, how it fits into you describe. You pay Fiverr 100 for a logo. Fiverr takes 25, which is a marketplace revenue. Happens around that transaction. Freelance paid 5 to promote the gig. Services revenue. You pay 20 extra for faster delivery. Freelance pays monthly subscription. There you go. See, it's some pretty decent questions to ask that, this end-to-end thing. Certainly helpful. Marketplaces Uber taking a cut of each ride. Services Uber also charging driver for ads, tools and subscriptions. Okay. But it doesn't look great, does it? That's not got any revenue at the moment. Do I drag this in or not? Or do we just ask a few more questions and move on? Sorry, where were we there? Financial income. Okay, so their net income is not from the core business, it's from... Let's ask. Their core business made a loss for the last 3 years. Net income is only positive due to finance income. Financial income is right as it is. What is this? Is the core business struggling? I would say it is. Pressing the wrong button. Financial income is not the core business, it's mostly interest in investment related gains. And yes, your observation points to something real. Fiverr's reported profitability has leaned on non-operating income. It doesn't automatically mean the core is broken. Interest income, biggest driver. Fiverr holds a large cash balance. That cash is invested, so okay. Foreign exchange, investment. Why is this boosting? Core operations, low profit or slight loss. Financial net income that's positive even if operations alone are weak. Is the core business actually struggling, slowing growth post-COVID? Active buyers declining, marketing costs still significant. High margins, gross margins of 80+%. Yes, that is true. Strong free cash flow. Also true. There's a lot added back into it by the look of it. Key accounting distinction, operating income, revenue, operating cost, chosen marketplace itself is profitable. Net income includes... Yeah, but they're fucking themselves over with all these high costs. What's added back in from the cash flow here? Look, net income of 20 million, DNA, share-based comp. Like I said, that's a lot, mind. I'm not keen on that. It would be interesting actually just to drag it in and see what the share count is. Has been. Then we can move on from it because I'm not keen on this already. FVRR. I know it's something that they do, but to rely on their cash to make the money instead of the business, that's not good. Not in the way that I look at things. Now, that doesn't mean I'm looking at it correctly. I will say that. We got it in there. No, it's declined. Well, it stayed pretty consistent actually. So they do have 80% of gross margin, simple free cash flow margin, average 3 years, 15%. But it's come from something else, and 103 million. Is that not taking out the 50 million in stock comp? Where am I getting this from? I feel like this is no longer taking out stock comp. What's happened there? CFS B10 to E10. What's that? No, it is taken out. Oh, it's fucking got any in it, look. That's why. Recorded no stock comp for the last four months. Which, as this is 12 months, that is not correct. So we'll just put all of it, 51389, in here. 51389 Is that right? Yeah. And now we'll have a look at it. Simple free cash flow 51 million. And now see your free cash flow margins dropped from 15 down to 11. So we've got 50 million on such a low EV though, if that is correct. What am I doing? EV 145 million, yeah. Which this cash is restricted on the balance sheet. None of it by the look of it. What's the user funds? What is user funds on the balance sheet? Fiverr user funds, money held on behalf of the user, not the company's own. It comes directly from escrow. Okay. Alright. Fiverr holds the money, it's the holding of the money. So, where were we? 50 million free cash flow. I mean, to the EV. No, is the EV counting that in? Let's have a look. Cash and short-term equivalents. 139 million. What have we got on here? 125 marketable securities. So is that on there as well? Cash and marketable securities. Cash and short-term investments 276. Other current assets of 164. So that will probably be the user funds. Okay, it's yes, it's wrong. The data's wrong, but it ain't far out, is it? You just need to be in a ballpark. So my enterprise value calculation won't be calculating that, will it? Where is it? Down at enterprise value. 59, which is market cap. Yeah. Plus BSB9, which is cash and short-term investments, 270 million. Got that wrong, haven't I? Reading it wrong, alright, minus B9, sorry, plus B28 and B34, which should be short-term and long-term debt, 28, short-term debt, 34, long-term debt. That doesn't look right. That does not look right. Do they not have debt? Convertible notes, 0. Current liabilities, long-term liabilities. Let's have a look on the notes then. Drag up the actual 20F. It's easier when you do it this way. Supposedly got no debt. I mean, they couldn't. They, you know, sorry, they might not. Convertible notes. 460 million, 0% coupon rate. Convertible notes are convertible based on convertible notes that mature on November the 1st, 2025, unless early repurchase. So, is that what we're seeing up here? It went from, where is it? There you go, 460 down to nothing. So they might not have any debt. That may be the case. So is it cheap or is it not? Oh, I fucking hate it when it's like this because my I'm not skilled enough to make a determination on that. I'll be back in a second, hang on. Alright, and I'm back. Honestly, that was fucking stressful. Trying to change a nappy on a screaming baby that's just learned to roll over. Not easy. I can't remember what we were talking about now. The enterprise value of it, I think. Problem is, like, I gave all this new, I put all this new criteria in so I could say no faster. And at the moment, we spent I don't know what it is now because I had to start a new video, but we've spent probably the best part of an hour looking at 2 stocks. We need to start like smashing through some more, I think, a bit faster. Let's ask for forecasts. Have Fiverr given any forecasts for revenues or free cash flow? So I'd imagine as their core earnings are rubbish, they'd be more keen on free cash flow. Roughly 12 to 33% year-on-year growth. Is it then? Revenues 429 million. Roughly minus 12. Oh, okay. Sorry, I see. Yeah. Minus 12. Reading it wrong. Quarterly guidance. Flat to declining top line. Adjusted EBITDA. EBITDA margin 18% at midpoint. Have I got EBITDA margin in here? No, I got free cash flow margin instead. Okay. How to infer free cash flow from their guidance? CapEx very low. So what I'm going to say, estimate 60 to 80 million, but again, not company guidance. But then they're going to put a stock comp on that as well. Anyway, I'm out because it's just not, the core business ain't good enough. Is it ultimately, is what we found, the core business isn't good enough. They're relying heavily on their large cash holdings to return a profit. And then, even though they're not making, the core business isn't making fucking money, they're heavily bloody rewarding themselves with stock comp. So, move on from that one. What's this one? No, we looked at that one, haven't we? The high water ethanol. I'm not keen on this just because of the shape of it, so I'm just going to say no. I'll put it as red. Talent Solutions. Price to free cash flow of 3, apparently. We'll have a look. Alright. Control C, because we're going to copy and paste these exact questions. So it ain't Fiverr International, it is KELYA Services. What the fuck did I just say? KELYA Solutions or something? Is that right? Where the fuck did I read that? KELYA Services. Oh, I've just remembered it wrong and now I look even more stupid. KELYA Services, what's the ticker? KELYA. Global staffing workforce solution company. Its core is an intermediary between employees and labor. How it makes money. Hires workers and places them at client companies, bills clients hourly. Okay. I've looked at one of these before. I can't remember who I've looked at, but I have looked at one of these before. Let's have a look. So, no real downside protection from assets can be expected. It's more of a technology type company. Simple free cash flow of 114 million. Alright. It was 15.8, so what's happened there? Let's just put straight up into the thing. Interactive, let's have a look at the balance sheet quickly. 33 million in cash, owed 1.2 billion, 20 million property, plant and equipment, leases I don't like, goodwill in intangible assets, so 225 million, say. Well, so say there's 2 billion in assets. No, there's not, because there's 400, sorry, in it. 425. There's 1.75 billion in assets. Rough figures. It's only 4 and... Oh, no, it's not, it's 1.2. Total current liabilities, total non-current liabilities. They got in non-current liabilities, long-term debt of 101 million. Okay. Retirement benefits. Accounts payable, fucking hell, current year. That's, well, they were that high last year as well, mind. So what's happening in the cash flow statement? Impairment charge. So that's fucked the did it last year as well, mind. 2 years in a row of impairment charges. Stock comp 12 million. Still there. Not particularly high, is it? But it's still there. CapEx of only 8.5 million. What was it? An acquisition of a company, they bought a company. So did goodwill go up? No, it went down. Well, they wrote it off straight away. They haven't bought a company and wrote it off straight away, surely. I think that might be what's happened, just from the loose. Okay, now. Why is it so much? Why is... Let's just go to the earnings a minute. Why are the earnings so much better than what they were last year? Gross profit's the same. Earnings are less as well, revenue's less. No, they're not, they're worse. Miles worse, what an idiot. Oh, bear in mind here though. Alright. I was reading that wrong, wasn't I? Yes, the miles worse. Reading it wrong, my apologies. This is why you shouldn't listen to a lot of the stuff that I say, because I'm very clearly stupid. So, accounts payable. What are payables doing as well? Are they growing or are they shrinking? Growing. They are growing. Where was the stock comp? 20, so with capital expenditures 21. So say you got 100 million free cash. But what happened last year? Because this is so negative. Oh, because you had a huge tax benefit. That was the Kelly Services bloody conversation, wasn't it? Yeah. Explain the huge tax benefit to CFO. 168.5 million added. Flow from operations started net income, which includes but cash flow non-cash items, timing differences. The company records tax benefit in the earnings it didn't generate cash. It gets reversed, added back to. Kind of large benefit is almost always driven by deferred tax assets, recognised in increased accounting impact. Big tax benefit boosts net income. Cash impact is zero, immediate cash impact it adds back. How does it boost net income and then get added back then? Possible contributors, prior year losses becoming unusable. Net income includes 168.5. That's sorry, I'm on the wrong one. 175.3. CFO removes non-cash effects. But how did they both go up then? This is a learning thing here for me. Explain how both net income and CFO go up if no actual cash has moved. Oh, benefits are loss, is it? Income tax, I'm reading it fucking wrong, okay. Say paid 175 million in income tax. They paid 175 million in income tax on the income statement. This is significantly higher than prior years. Explain this happen. So they got an expense of 175 million but haven't paid the... Is that what we're saying? Amount of messages. Oh, okay, doesn't matter. It's going to use a lower one. If they have a tax expense of 175 million, but 168 million is added CFO, does that mean they haven't yet paid those taxes? I'm going to say yes, and it's a timing thing. Does not mean they haven't paid the taxes yet. Timing plus classification mismatch between accounting expense and actual tax payments. So 175 million tax expense cap measure, it includes cash taxes owed. So only part of that 175 million is actual cash paid. Oh, sorry. Cash flow from operations removed non-cash tax components such as deferred. So they have paid 175 million in cash. Short answer, no. Not as a single cash payment tied to that income statement number. Paid some portion in cash, deferred or accrued the rest. How this usually splits in practice. So, real cash outflow, deferred tax expense. If they've got deferred taxes, would that not be on the income statement? Income statement possible. Current tax. Income tax expense equals current tax plus deferred tax. Is that right? Yes, it is. Okay. So deferred tax is already embedded inside that 175 million number. You'll see deferred tax assets, deferred tax liabilities, deferred taxes in assets 163 million. And it's not in there. It's not in there. Okay. Possibly should be, I don't know. Then future, these represent... This is where confusion happens. Deferred tax charges, changes appear as deferred taxes income added back because they are non-cash accounting entries, not actual cash paid received. Why it looks like it's missing sometimes. You saw 100 in income statement, add it back in. Where did this tax go? It's not cash, it's already sitting inside deferred tax balances on the balance sheet. Think of it as tax in for income statement, shows tax expense. Balance sheet stores the cumulative differences. So they wrote down the deferred tax asset. That's what's happened? Let me just check this. Ooh. I can't even spell. For taxes declined year on year on the balance sheet. 330 to 163. It's this, them using this deferred tax asset. Future tax benefits. The main explanation, yes, likely usage of DTAs. This connects to earlier add back. Deferred taxes down 167 million add back. These are very like the same economic event viewed from two different angles. Okay. All right. Yes, I said I want to get away quicker from stuff because we've literally looked at 2 companies, maybe 3 now. I can't remember. But I did. That is an interesting thing to learn, especially if you don't know what you're doing. So don't mind that one so much. But free cash flow would be negative, wouldn't it, if it wasn't for that? Last year would have been positive, would it? It's not true free cash flow, is it? Business is losing money. Okay, the goodwill. It wouldn't have done if it wasn't for the goodwill impairment. It would have been about 20 million up, but it's still got taxes. Right. Anyway, I'm going to move on from this one. I just don't really like the look of it. Not going to give it a red. No, but not going to look at an investment partner. Upwork. I'm sure I looked at that. Did I not look at that in my last video? Let me just have a look on my phone. I'm sure I've looked at Upwork. Sorry, nothing's happening on your screen at the moment, so I'm sure it's very boring. Yeah, I did look at Upwork in the last video. Did I not look at it properly then? I don't know, maybe I just didn't do that. Lean, Chicago Atlantic operates closed-end investment management fund, not interested in that. Digital health company engagement provision of digital health messaging. What the fuck's happened here? This has been all over the place at COVID. Absolutely COVID. Note where it was before COVID as well. Starting to do all right, I suppose. We are sort of on a OPRX in a quick take. Positive return on capital, simple free cash flow, 18 million. Bet there's some fucking stock comp in this. Price to tangible book working out. Let's have a look. OPRX. Let's just have a look a minute because I didn't do this, did I? Oh. Yeah. Oh, people have been buying. People have been buying this year in March. Is it a significant amount? I suppose it is cumulatively. Isn't it? Right, let's just get this advert out of the way. Because it's gone midnight. Let's advert. Making me look at adverts. Yeah, I suppose it is in total. KELYA, let's have a look. Owners, nobody. Look, absolutely fucking nobody. Right. OPRX. Nobody. Owners. Just do this bit quickly. God, what is it? OptimizeRx core. Yeah. Owners. Ooh, 5%. Get the balance sheet up because this is one I reckon is going to have negative. Simple free cash flow if it wasn't for stock comp. Interactive data. Financial statements, balance sheet. Let's just have a look at the balance sheet a minute. 23 million in cash. Plus accounts receivables. Say 80% of that. So we've got 50 million. 50 million in current. I say 80%, that's what would be recoverable. Generally, they reckon you can recover around 70 to 80% of receivables. From what I've read, I don't know that to be true, but from what I've read, if you were in liquidation receivables, you could potentially recover around 70 to 80% using debt recovery companies. So, total assets. A lot of that is 100 million in that is intangible, so no wonder negative. Total liabilities ain't too high though. There is still a positive tangible book. Long-term debt of 21 million covered by cash. Current portion of long-term debt. Okay, so balance sheet ain't too bad, is it? It can cover the debt. What's going on with the earnings then? Stock-based comp 7 million. Okay. So what's this? Capitalized development costs. Don't know what that is. Purchase property. I don't even know what this business does really. I should have started with that, shouldn't I? OptimizeRx Corp. Go on over it. OPRX. Pharmaceutical companies, customers paying for market and access, healthcare providers. Its platform delivers real-time point-of-care digital messaging. 4:09 AM. I ain't staying up that late, although it is gone midnight now. When a doctor is prescribing a drug, Optimize can show the copay affordability savings, offers drug awareness, promotional patient support programs, happens inside prescribing software, making it highly targeted in workflow, ensures a healthcare ad tech data platform that monetizes access to prescribing moments. Paying for digital engagement campaigns and platform access. Platform subscription. I don't really like this sort of company, to be honest. OPRX officially reports a single operating segment. 100% of revenues in the United States. Not normally keen on these sort of healthcare stuff. Net income 5 million. So what's all this added back in? Stock comp to take away. What else has been added back in? Depreciation is very high for something that's is that because of the goodwill hasn't changed? What has changed? Trade names, customer relationships. Are they depreciating that? Let's ask. Depreciation is very high for a company whose capex is very low. Not only tied to current year. I know, I get that, yeah. Yes. Okay. What's likely happening for a company? Depreciation is usually dominated by intangible amortization, yeah. That's what I was saying, the customer relationships and stuff like that. There you go. Customer relationships, technology, software. This creates non-cash amortization expense that can stay high for years, even if capex is minimal today. Right, okay. Fine with that. That's what I thought it would be, but it's been confirmed. Revenue share payable. What's that? Revenue share. Key cost structure item, how the company access then distributes its healthcare messaging through third-party networks. It's not fully owned distribution platform, relies heavily on EHR systems, pharmacy networks, and data. Goes after it earns revenue, sells a campaign, collects revenue from the pharma clients, then pays a contractual percent to the partners who enable delivery. What's the fucking market cap? 100 million. Very interesting. You've got like 10 million in, so it's 10 times earnings anyway on free cash flow. This is if this is correct. Enterprise value of 120, so it's 12 times earnings. If we got it as a EV is simple free cash flow. Oh, it's because they're not taking away the. Oh god, don't want to fuck this up. Let's copy and paste this a minute, and I can put it back in, but. 10 million. All of a sudden, yeah. 11, 12, that's right, okay. Not interested then. Not interested. I've got to be honest, the screener that I've done, I'm starting to get within the realms of not really keen on them already. If I'm going to be strict enough, like Monish Babrai and all that, and I want my payback a lot faster. Why was I looking at Western Union when it's so... What's happened to that price? Nothing. Maybe what I'll do in the next video is we'll start doing some insider buying. Basically, I'm not interested in this at 12 times earnings. What has revenues done? Oh, they are increasing, mind. Let's see what they forecast. Oh, what's going on here? I pressed the wrong bloody thing. So they do think it's going to continue. That is interesting. There's only a consensus range, though, not what they've said, is it? Analyst consensus and forward estimates. So nothing from the company. Oh. Short answer, no. Nothing from the company. It's explicitly guided 2026, so basically flat, okay. Not going to pay 12 times earnings, 12 times simple free cash flow for flat earnings. Where were we? OPRX there. Yeah, anyway, I was just going to have a quick look at what we might do next time and start going down through insider buys and see whether or not we can find anything cheap. Looked at these before, but this fucks me off. I used to be able to see the graph, and now it's not there. State Bank, People's Financial, PFBX. Okay. Sunoco, Son. Done alright since then. I mean, it's come right back down again now, but we're just doodling around a little bit now. The only other thing I suppose I could do, we could go down through here. The other thing I suppose that I could do is, what do I want? Above 200k. How do I do that? Traded min 200k. Search. No, I don't want sale, I just want purchase. We could do it from here, or I could change the area in which the screen's participating in. I don't know. Because obviously this is all done on current earnings as well. There's no trailing TTM. I don't think there's any. Oh, pardon me. Maybe I should keep going down through it and bang it in the quick take spreadsheet and see what previous free cash flow multiples were. Doesn't mean they're going to get it back now today, does it? But if they were quite low back here and now all of a sudden it's quite high, is it an outlier? Maybe we'll continue with this spreadsheet and I'll just do it fast, like I keep meaning to. We do it fast through the quick take spreadsheet and just look at previous multiples and tangible book values and stuff as well, depending on what the business is. That's probably what I would do. Alright. I'll leave this video here. We've got a few options for what we can do in the next video. Nothing. Another bank one, look, HBAT. I'm not normally interested in banks, but when I missed out on that first bank shares one, I would imagine most of the regional banks have now recovered anyway from the regional banking crisis from, what's that, last year, beginning of last year, maybe the year before that. Somewhere around here, or somewhere around here. Yeah, anyway, right, I'm going to head on. Just remember, I don't know what I'm doing. All of this is in my opinion. None of it is financial guidance. Literally don't know what I'm doing. Do not invest on anything that I say. Please like and subscribe if you want to follow me on this journey. And I will see you on the next one. Thank you very much. All right, goodbye.